Llévate más de lo que esperas todos los días con el nuevo McValue en McDonald's. Ahora puedes comprar uno y sumarle otro por $1. Así que cuando tu equipo favorito enfrente a sus rivales, enfrenta tus antojos con $5 Meal Deals. Y si estás corriendo para alcanzar el desayuno, corre a la para llevarte ofertas antes del cutoff. Tú decides, y con McValue, tu decisión siempre rinde más. Precios y participación pueden variar. BOGO $1 válido para un producto de igual o menor valor. Debe estar registrado en Rewards para ofertas en el app.
Reality radio for a really great future. We're talking real money.
Well, welcome to Talking Real Money. A little different this week. I'm Tom Cock. Don McDonald has the week off for the first time in a long time, so I hope he's out enjoying himself on this Easter weekend. I've got a special guest. We'll talk to him in a couple of minutes, but, you know, a little spoiled having just gotten back from a wonderful week in the Southwest where, I hate to mention this, truly I do, because when we left last Sunday, it was actually snowing, and then when we got to Phoenix, it was, I think, 41 degrees warmer. So it was quite a change in the weather. But I got to admit, I am a lousy vacationer. The truth hurts, but it's the truth. And it brings to mind something about investing that I'll mention here, but I do want to mention our phone number because the phones are open and we always go to you first, 855-935-8255. And you can call us anytime, day or night, but we'll take the calls live and our guest will take them as well. So join us. But so here we are. We go on this wonderful vacation, and my beautiful wife, Danielle, put it all together, which is even nicer because then I just have to get on the plane. We even flew out of Payne Field, which is really painless so many ways compared to SeaTac. You basically park the car, sort of walk in and get on the plane. It's really nice deal. But as I said, I am really not a very good vacationer. I have a routine, and I just have a hard time breaking it. I'm kind of early to bed, early to morning kind of guy. For all that I wanted to not work, I still end up working quite a bit. Saw a few clients, and I tend to be still, it's probably an age thing, less flexible than I used to be. Let's put it that way. But so we're in this great place. Kinda. There was a few problems. The house that we rented, half of it didn't have electricity when we arrived, and despite trying to work with the agency that rented to us, it wasn't back on for about a day. We rented a car where the first time I pushed the brakes down, it made this horrendous sound like it was, at one point I think we got out of the car to make sure nothing had dropped off. But the biggest issue, interestingly enough, was food, because when you go somewhere for a week, I don't want to go out every night. I'm kind of like, let's get some food, let's cook it up. But always that first day when you get there, you just don't feel like going out and getting I guess I'm lazy. So we kind of sat around for a while. We got to the end of the day and we're trying to figure out what to do about dinner. And of course, we're in Phoenix. You're going to get Mexican food, right? I mean, it's just, or Southwest, or you're going to do it because that's where you are. So we made a few phone calls to folks, and of course, everybody was busy. This is the middle of spring break. Until we found a place. Well, I'll just call it Al's, okay? Because Al's in the title. Now, I'm trying to figure out how Al relates to Mexican food, which I couldn't do, and maybe I should have been warned. So we went to Al's, and, no offense to the elderly among us, present company excluded, but the average age in Al's was probably mid-80s. And again, a little on the older side. The place looked a little run down, and then the food came out, and it was awful. But all I wanted was the mole. I wanted a mole. But Al's was missing the mole. They didn't have a mole, and I got a chimichanga with 8 pounds of cheese on it, which I ate a little bit of. Really wasn't there. But it always brings to mind what you want to know from us, from me. If Don were here, he'd be asking the same question, and that is kind of, what do I do now? What's the thing I should invest in now? I just took this up with my brother this morning because he has some money. Like, what do I invest in now? And the answer always is, I don't know, because you got to have a plan. Had we had a better plan on Sunday, I would have ended up with the mole at a good place, but we didn't. You've got to have a plan. You need to know the purpose of any money you're thinking about investing. Is it for your retirement? Is it for a house? Is it for college? Is it for next month's unexpected expenses? That has to be first. What has to be next is sort of how much of your money are you willing to risk to see go up and down. And in a couple minutes, we'll talk about going down, because in this very unusual year, actually stocks and bonds have decreased in value. And as my brother pointed out today, hey, generally don't, when stocks go up, don't bond go down, don't stocks, bonds go up, pardon me. I said, not always. Those are things you're going to learn. So have the plan, know your risk tolerance, put it in action, and you will not be missing Al's mole as well. 855-935-TALK. We'll come back here on Talking Real Money in just a moment.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Welcome back to Talking Real Money. Tom Cock here, Don McDonald with the week off. Thank you for joining us. Telephone lines open for you, no matter where you are. 855-935-TALK, 855-935-8255. Taking time out from his egg roll today is our guest. Really glad to see him. He's been a friend, a colleague, a mentor for, more years than it's over 30, I know that. You also know him from his fine work in so many places. Market Watch, he's always writing. He's written a relatively new book, We're Talking Millions. And, of course, started a great asset management firm, financial advising firm, Merriman, which is still there. It's still doing great work. Paul Merriman, thanks for joining us here on Talking Real Money.
It is great to be back, Tom. It's been a long time since we've worked together.
That is true. And Paul will be there at Retire Meet in less than a month. But let's go to the phones first. We do have some topics for Paul, which the aforementioned, hey, wait, stocks and bonds went down. Why is that? So we'll take that up in a minute, but let's see if we can get to the phones first. And with that in mind, let's go to Kathy. Hi, Kathy.
Hi.
How are you?
Good. How about you?
Doing great. How can we help?
I'd like some advice on long-term investment. We have some money to put aside for each of our grandchildren. We're starting with $5,000. This is like a 20-year time period we're talking about. I've heard you talk about the Vanguard funds, but I'm thinking that maybe one of those would work, but I'm not sure which one.
Well, those could work, but here's the interesting thing. As we were walking in the studio today, Paul said, I have a brand new program for grandparents that we got to get out there. So, wow, this is, there's a word for this, but this is good timing. Well, Paul, what's the new program?
You know, Kathy is my sister.
Okay. Should have known that. So, sorry.
No. Kathy, are you going to the Retire Meet?
No, I'm not.
Are you going to watch it on the internet?
He's working it. I like that. She could say no.
Yeah.
Okay. Oh, okay.
Yes,
All
okay.
Right. Good.
Because at the Retire Meet, I'm going to speak for half an hour, and I'm going to focus not just on the S&P 500, but I'm going to focus on a small cap value. And I'm going to be talking about a strategy for a newborn or a young child. And I'm talking about a multi-million-dollar impact on that child over a lifetime.
So what's the fund?
Well, okay. What's the fund?
Give it out.
Well, a small cap fund right now that I would recommend the Avantis small cap value.
AVUV?
AVUV.
I know.
But it isn't about the fund because we're talking about 80, 70, 60, 50 years here. It's about having some money in that particular asset class. And there's nothing wrong with the S&P 500 or the total market. But I think, Kathy, you'll be amazed at the implications of the combination of those two or even just one of them if you have the kind of risk tolerance that you need for that much volatility. But please, I can't tell you everything right now, or people won't come listen to me.
Oh, you're killing me. Yeah, so that is a that's an exchange-traded fund. It's operated by Avantis. It is in small. How give me another word for value, because that's
well, there are companies that are basically kind of out of favor.
Yeah,
for
okay,
example,
fair.
For example, if you looked at large cap blend like the S&P 500, growth oriented, it's about a 30 PE ratio, price to earnings.
Yeah.
If you looked at the value, it's about 15 times.
So you expect
earnings.
at some point that will get the equilibrium will be met, and you will have gained return in that.
Kind of like that.
Okay.
I mean, it's close enough for
all right
for the
me.
radio.
Close enough for me. Yeah, good.
No, but value over time historically, because it's more risky, that's important, has produced better returns than the growth-oriented. But for this young person, I'm thinking I want to have a lot more value in there and small than I do want large and growth.
Kathy, thank you for your call. AVUV again from Avantis is Paul's record. There are others. Vanguard is a very fine small cap value fund too, but this Avant, they do things just a little differently than Vanguard, that it may give you some additional return. 855-935-TALK is our telephone number. Let's go back to the phones where we chat with Brian. Hi, Brian.
Hi, Tom, and hi, Paul.
Hey, Brian.
You guys work. Thank you. Thank you. Hello. I've got a question today. Well, it's for both of you guys. I'm kind of confused about what I'm doing here in my Roth versus my taxable. In my Roth, I'm using the Merriman Aggressive Glide Path, and that's where you start with all small value, emerging markets, small blend, large value, until it's 60-40 stocks and bonds. But in my taxable, it's harder to do that. And so I'm wondering, should I just think more simply, own the whole portfolio of equities at once, and then maybe add muni bonds 10 years before I retire? Or how should I think about taxable?
I like your thinking, by the way, because you're thinking about not just the investing part, but the tax part, which people oftentimes don't think through. Yes, in a taxable account, we want them there to be owned tax-efficient things. Stocks are generally more efficient than bonds, certainly. But what's your take on that in terms of the actual operation of those two places, Paul?
Well, this is one of the challenges of a teacher. I mean, Tom has a financial planning company. I am but a teacher at age 78, Brian. So be patient with me. But I would generally, as a teacher, be saying that I would want you to have the more tax-efficient investments inside of your taxable account.
Which would be what?
Well, it would be
Stocks?
equities to begin with.
Sure.
And even in the equities arena, would probably be better off in the S&P 500 than value, because you're going to have fewer taxable events.
And by the way, now using exchange-traded funds in that taxable account eliminates another place where you saw taxation with mutual funds. So then you would be holding the fixed income, Brian, the bonds in the pre-tax. Or no, you said it was Roth versus taxable.
Well, but here's where I get confused, because, Brian, you sound young. I would have guessed you are 34 years old. How old are you?
Oh, you make me feel good. I'm a little older than that. I'm almost 40. I'm about 38 going on 39.
Yeah, you're way too early to be even thinking about. I mean, again, for both of those accounts, I'd be all about the growth at this point and worrying about sort of mixing in the more stable parts of the portfolio later when you really get old, like 50.
And we're talking about a glide path here, Brian. I mean, this is important, I think. You should have a glide path from now until you retire. You have too much fixed income, as Tom just said. Look at the Vanguard glide path. You can do that. And I would think that you should have, at this point in your life, less than 40%, probably more like 10 or 20 at the most in fixed income.
Yeah, and you can always, by the way, go to talkingrealmoney.com and take the risk quiz just to see how you deal with the emotions of investing. We'll continue more here, 855-935-8255 with your calls. Paul Merriman is our guest. More from Talking Real Money in just a moment.
Tom and Don are talking real money.
Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at vestory.com, vestory.com.
For your real life and real future, Tom and Don are talking real money.
Thank you for joining us on Talking Real Money. 855-935-8255 is our number. Here to answer all kinds of questions about money, help you do better with it, help you deal with it, help you put it in its own place, too, by the way. I think many people spend way too much time worrying about it. So we're here to help you worry less. Our guest is Paul Merriman, who really needs no introduction, but he's written, he's spoken, and he's still doing it all. And we won't say you got a big birthday in a year from now. We'll leave that alone. But you have one in October, but then the next year is really kind of a bigger one. So we'll leave that for now.
But I do take a lot of naps. I just want you to know.
I hope you're not going to do one in the next hour and a half. Again, the phone number is there. We're happy to take your calls. And let's, with that in mind, let's go to Michelle. And Michelle, thanks for joining us here on Talking Real Money.
Hi there. So this year I'm turning 61, but I plan on retiring. I've been working for the state of Washington for about 33 years. I joined the PERS 3 retirement system, if you're familiar with that.
Yep.
When they offered us, I did it when they offered us the buyout. So I took what I had in PERS 2. They gave me 110% on top of that. And I've set that money aside. I left it. I didn't know anything about money back in those days. Still don't know much now, but I left it just invested in the general retirement pool with Washington State. Last year, I ended up with a 20% rate of return in that account. It's almost $600,000. I have my defined benefit, which is going to be about $2,500 a month, and then I plan on pulling my Social Security. Now I'm not going to wait. And then I have another account with about $110,000 in it. It's like a savings account. So I think my biggest question is that my lump sum that's setting in PERS 3, should I leave it there or should I pull it out and invest it in something else?
Well, that is always the $1,000,000 question. But before we even get to that, I have to ask you about Social Security. Why are you planning on pulling that at 62 or close to that age?
Because maybe I'm pessimistic. I just don't want to wait and have that money evaporate, and then I don't ever have access to it.
So when you say evaporate, tell me more about that.
Well, I'm just talking about, and if I waited till I'm, 72 when they tell you to take it, will there still be Social Security funds available?
Yes, unequivocally. And you can come to my house if I'm wrong, and I'll give you the money.
Okay,
now, I'm not going to tell you where I live,
yeah.
but no, I mean, because this aspect of sort of it won't be, yes, it will be there. Do I think for people maybe under the age of 40, it'll look different in terms of what the benefit will be? Yeah, I do. But for those, and I'm in my 60s too, there's no question. And by the way, the change they need to make it sustainable, very simple, and they still don't have to do it for another 12 or 13 years. So that means Congress will do it in 12 and a half years. So we got that coming. But no, I wouldn't worry about that. But back to the $600,000. So you're going to have Social Security. You're going to have a pension. Here's the only reason that I might like liquidity in the other account. In other words, taking the money out and investing it in some way, is that then you have really a three-legged stool, right? You could have draw on the $600,000 as you needed it while you're getting the fixed income of the defined benefit and the Social Security. Paul, what's your take?
Well, I think that she needs to sit down with somebody and find out more about cost of living and those things that would indicate where that money needs to come from. And I'm absolutely, Tom, I'm on your side about this Social Security question. And I got to tell you, Michelle, if I could recommend one thing, and I promise I will ask this lady your question about will it be there. Next Thursday, I'm going to be doing an interview with Mary Beth Franklin.
Oh, yeah, sure. Know her work.
She is one of the
big expert on Social Security.
And so if you're interested, you go to Bainbridge.
You don't have to go Bainbridge, the website.
That's the website.
Okay, I was going to say you have to get on a boat for that. Okay, for a good swimmer.
That stands for communityfoundation.org.
And this is on your website, though, too, right?
Well, I think it's on our website, but I know it's on the Bainbridge because they're the sponsor of it.
Okay, so it will, and we'll give Paul's website here in a bit. But, Michelle, again, I think Paul is right to have a plan first I was just trying to give you a piece of general advice today. But to have a plan, as Paul said, know how much you need in retirement, what sources you're going to be able to take it from, and then decide whether this should be left there, moved out in a lump sum, or whatever it is, because those are big decisions indeed that you need to make. So thank you for your call. Thank you for joining us. We're going to come back. We'll talk about stocks and bonds lost money. Paul, you told me that could never happen, right?
Did I say that?
No, you never did say that, but I thought I'd say it anyway. So we'll come back with that. Your questions and calls, 855-935-8255, as we continue here on Talking Real Money.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at vestory.com, vestory.com.
Reality radio for a really great future. We're talking real money.
Thank you for joining us on the program. Love to talk to you about money, anything relating to money. We already talked about what to do for your grandkids, how to build the right portfolio at age 40, kind of retirement issues. So a little bit of running the gamut already. So give us a ring, 855-935-TALK. That's 855-935-8255. I'm Tom Cock. Don McDonald has the week off. Very happy to have a longtime friend, colleague friend. You actually called me in your kind email yesterday to promote the show, Paul Merriman. Thanks, Paul, for being on here.
Tom, I've got to ask you a big question.
Uh-oh, yeah.
Are you on Facebook?
I am not.
I knew it. Ask me why I knew it.
How's that?
Because at 3 o'clock in the morning, this morning,
yeah,
I knew that today is Debbie McDonald's birthday.
Oh, look at you. Yes, it is Debbie McDonald's birthday. That's where Dawn is, yeah.
And I wrote on her Facebook
her wall
page,
or whatever, yeah.
I told her, I know why I'm going to work with Tom, because Don is taking care of his wife.
By the way, guess how well that went over at my house when I told her I wasn't. Anyway, so we'll just leave it at that. Happy birthday, Debbie, and we miss you, Don. But all right, so and that's money related because it may end up costing me money anyway. So here we go. But let's talk a little bit about the markets. You know, we try not to talk about short-term performance, but this has been a bit of an odd year, 2022. If 100% stock portfolio, by the way, is down a little over 4.5%. Big deal. Portfolio 60% in a globally diversified portfolio, 40% in bonds is down 4%, and a portfolio 40% stocks, 60% bonds, very conservative, I would say, is down 3.8. Here's where it starts to get a little weird. These numbers around bonds, because even my brother, who is not financially literate, I wouldn't say I love him, but he's not. He pointed out, wait a minute, stocks are down, but bonds are down too, and they're not down a little. I mean, the Vanguard Total Bond Fund, VBTLX, is down 8.7% year to date. The Vanguard Short-Term Investment Grade Bond Fund, down 4.4%. Dimensional Funds, Very Fine Intermediate Term Government Bond Fund, DFIGX, down 8.5%. And I thought, well, no, okay, those are just indexes. Well, those are just indexes. Let's look at the smart people, the people that run the bond money. And I just read The Bond King about Bill Gross. And I think his fund used to be the PIMCO Total Return Bond Fund, PTTRX. It's down 8.7%. But maybe Jeffrey Goonlatch over at Double Line's gotten a lot smarter than the people to PIMCO. Let's go check his return, the Double Line Total Return Fund. It's down 6.7%. A lot of numbers there, but at the end of the day, those bond funds are down, my friend. Why would I invest in bonds? It makes no sense.
Look, I put on the internet for everybody to see for nothing tables of year-by-year results for bonds.
Yes.
I show them over the last 52 years, the worst 3 months in bond. Now, by the way, not long-term bonds, because I'm not a fan of long-term bonds.
You're talking about intermediate term around 10 years.
Stability.
Okay.
Some short, some tips, some intermediate.
Mm-hmm.
And for so far this year, that portfolio is down 4.1%. But what we look at in the past is 3 month, 6 month, 1 year. When I look at the worst 3 month experience over the last 52 years, it was a loss of 5.2.
Oh, so that was like mid-90s, right? 93, 94, something?
Probably the 80s,
okay.
maybe.
All right. Okay. So the worst, so it still wasn't, because somebody asked me, this hasn't been the worst quarter for bonds in history.
3.5 is what our strategy is down.
Okay. In the first quarter.
In the last 3 months.
Yeah, okay.
But here's the point, is that every one of us, I think, should know, with whatever combination of fixed income and equity we have, what's the risk in the past, so that when it happens, we're not panicked and thinking the world's coming to an end. We stay the course and say, this is what I expected. And I think if you don't have a good background on that historical information, it is very easy to panic and think all hell is breaking loose. And here's the real problem. People will say, Merriman, are you nuts? You're recommending bonds? I mean, they're losing money.
And you stay right there. We'll come back and talk about that in just a minute, okay?
You got it.
They've lost money, by the way. We always need to use the past tense when it comes to money, because what they've done. Future, nobody knows. We'll come back. We'll take that up. We'll also talk a little bit about financial literacy, which, quite frankly, the news is not good there, but we'll take your calls as well. 855-935-8255 as we continue talking real money.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Thanks for joining us. I hope you're getting ready for Easter. Maybe an egg roll, maybe painting eggs, maybe throwing eggs. Maybe not at our guest, but yours truly probably deserves a few. I'm Tom Cock. Don McDonald is on vacation, as Paul mentioned. He's out with his charming wife this weekend, whose birthday is today. And so Paul Merriman is here stepping in ably. Before we go back to the phones, though, you mentioned that, yes, bonds have had worse 3-month periods. That's good to hear, so it's not out of this world. But before we go back to the phones, what are you telling people if I asked you why bonds have gone down fairly dramatically? What would you tell them?
Well, long-term bonds have gone down because interest rates have gone up. And that's what happens. And that's the relationship. As interest rates go down, the bonds go up. And but the one point I want to make, Tom, is that people are all worried about losing a few percent on bonds. I understand that. I mean, that nobody likes to lose. But the risk in the S&P 500 is a loss of 40%
or more.
And so people calling me or emailing me and afraid of bonds when they're sitting on 60 or 80% of their portfolio in equities at much greater risk. They are doing what they're supposed to do. They're stabilizing.
The portfolio.
Sometimes they don't do it very well.
Yeah. Well, we'll hope, as I say, the higher rates obviously will lead to bond yields being higher, and that might stabilize things too, right? You're buying new bonds at a higher interest rate.
That happens over time.
Yeah.
But if you want to lose a lot of money this year, you have your money in 20-year treasuries.
How bad's that?
I mean, they're down, what, 20% or more?
That's right. They would have to be with that. All right, let's go back to the phones. 855-935-TALK. 8255 is what TALK is. So Kathy joins us here on Talking Real Money. Hi, Kathy.
Hi. I just talked to you about investing some money in my grandkids' college funds, and was guided toward the Vantis fund.
Avantis, yes.
Yes, but when I looked it up, it's 0.25 expense ratio as versus Vanguard small cap fund, which is a 0.07. So my question is, what am I missing?
Well, so here's the difference. Vanguard's is truly an index fund. In other words, it just holds whatever the ordained U.S. small cap value index is, which I believe is probably put out by S&P. Paul could tell me, I don't remember which index it needs to match. So it simply does that. Avantis, the fund is managed differently. It's going to have fewer securities. It's going to sort of tilt more to small and to value in a way that Vanguard's does not. And those two sort of premiums, if you will, have created greater returns over time. So you're paying a higher cost, correct? But over time, we believe, and we think the history shows us pretty well, that you would have made more money by having a stronger tilt to those parts of the portfolio than Vanguard provides. How would you put it, Paul?
Well, no, that's right, Tom. And there are long periods when growth does better than value, and then it flips the other way. And so if you're a buy and holder, you have to make a decision. Do I want to weight more to growth or weight more to value? And those that have the risk tolerance, and young people would be the most
good point.
perfect match, I think. But they are still a passively managed fund in a sense. Or let's call it a mechanical, automated discipline, that they are simply exposing you and your child to a part of the market, smaller companies that are out of favor, and they even weight it especially towards the highest quality companies in that particular area.
You're getting in the weeds here too far for me.
I know. But there's a reason, like last year, it was up over 42%.
Where the index was more like 20-something.
28,
right?
I think.
Yeah, right.
28.
Yeah,
and even other small-cap value funds were up more like 35 or to 39, I think. Some even less. But the bottom line is that they are a very low-cost provider of access through an ETF that is managed by people who all came out of dimensional funds.
Yeah, and it's academic-based work.
All
Again,
academic.
it's not nobody's reading tea leaves. I think you raise a good question, a good point, Kathy, and here's an idea. You could put half in one and half in the other. That's going to give you a little more growth, as Paul said, not quite as small, and a lower cost. So there's another idea as well.
Are you telling me she's got S&P 500 in the other half?
I was saying half in the Avantis fund, half in the Vanguard small, either way. So sort of hedge your bets a little bit there.
Okay.
But thank you for your call. Let's see if we can squeeze in another one here from Gene on Talking Real Money. Hi, Gene.
Well, good afternoon, gentlemen. Thank you for taking my call. I've got a situation here. I need I hope can get some insights. My dad died, and now I'm kind of looking after my mom's money. She has a small IRA. It's about 34,000, 32,000, something in that range, with a company called Baird, BAIRD. And in looking at her year-end statement for 2021, the thing that has me puzzled, she's 92. Her RMD is about a little over 3,000 a year. But when I look at the year-end statement, the statement says that $14,000 worth of transactions were made during the year.
Wait a minute. So they bought and sold half of the portfolio in 2021?
They just show the sales. I don't know where the money had to stay in the fund because the fund balance didn't change by that much. But
give me we're running out of time here, Gene.
Totally.
Yeah. I mean, so okay. What? Just give me one fund example that they're holding for her at Baird.
Well, they have the money distributed across 8 different funds.
Yeah, I mean that's just too many for me.
Russell. Oh, they're all Russell investment funds, different types. Some are bonds and some are stock.
Yeah, again,
I'm just concerned about that much sale.
That's too many for me. Too many transactions. We only have about 30 seconds. Paul,
well, it doesn't sound like rebalancing.
No, it doesn't.
Let's start there. I mean, it could be theoretically, but it sounds like they're index funds. If they're Russell funds, I would expect,
Yep.
although Russell's also
They
has
do.
funds where they
Yep.
have active management. I'd really be worried about how much in equities and how much in fixed income, because that's the driver of return and risk. And I know we don't have time to get into that right now.
No, and at 92, frankly, I mean, I wouldn't have very much equity exposure, maybe a little bit, maybe 10, 20%. Mostly should be in those aforementioned bonds that are more stable. So that would be the part I would look at first. Then would be the part about expenses, frankly, because even though you're in index or index style funds, I want to make sure they're inexpensive. And then the part about portfolio management. To buy and sell half of a portfolio, to me, feels outrageous. But again, I'd have to kind of know what they're trying to accomplish. Thanks for your call, Gene. We'll be right back. 855-935-TALK here on Talking Real Money.
Tom and Don are talking real money.
Want a free copy of my book, Financial Physics? Well, go download it right now at vestory.com, vestory.com.
For your real life and real future, Tom and Don are talking real money.
Well, I hope you'll come out and take part of Retire Meet. Paul mentioned it earlier this hour. It's coming up about a month from now, Saturday, the 14th of May in Maidbauer. Paul will be there among many other speakers. It's a great kind of 6 hours. It sounds like a lot, but it goes by quickly. And guess what? It's fairly inexpensive. You get lunch with it, and you hear from everybody about all things retirement, finances, housing, medical, all the stuff you really got to know. So it's very simple to register to join us. Get those tickets now because we will sell out the event again. You simply go to RetireMeet, MEET.com, RetireMeet, and sign up there. Join us that day. It's going to be a wonderful session, and I hope you'll be there for Retire Meet coming up soon.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.